So, Jason, it seems that last week the Federal Reserve dropped interest rates. They cut them by 50 basis points. But despite that, interest rates immediately after spiked up. Can you explain that why certain areas the interest rates actually rose after there was a cut?
There's a bunch of different factors, but what we usually look at is one, market expectations, bond reactions, economic outlook, and supply and demand. And to go into those a little bit, market expectations, the market expected a 50% basis cut. If it was 75%, 75 basis points, you would have seen mortgage rates go down because it would have been something different than the expectation. I think 60% of the market expected a 50 basis point cut. So it hit the market expectation. You could attribute it didn't they didn't go up much. They ticked up a little bit. And that could be a knee jerk of people thinking, the people that thought it was going to go 75 basis points, it didn't. There's a little bit of reaction there on the bond market. Mortgage rates are closely tied to the bond market and the yields on long-term bonds like the 10-year treasury note. So you got to look at that, what those are doing. When those bond returns are going up, mortgage rates are usually going up as well. Economic outlook, there's a positive outlook for the future, but again, this is day to day that we see these rates move up and down. There's people that get paid a lot more than me and you to watch this hour to hour and day to day, and they the markets move sometimes before the announcement comes. So we have had a very good run in the last 12 months with rates. They're down over one full percentage point from where they were last October. So it's a great time to get into the market. As I always say, marry the house, date the rate. There's opportunity to refinance down the road. So that's really what we attribute that most to. And then supply and demand. Again, if there's less flavor for the market for mortgage investments, then rates are going to go up because you've got to have a higher return in order for investors to move to that market.
Yeah, that makes sense. And we both share the same mindset about marrying the house and dating the rate because you can refinance potentially in the future whenever you get in a certain interest rate, but you can never change the amount that you paid for the house. So that's always going to remain the same.